Hello fellows, welcome to my channel. This channel is entirely dedicated and created for educational purposes only. Here you can find high quality educational materials to learn the basics, whether you are a beginner, more advanced or an intermediate trader. For people that want to see more action, you can check the link on the top right corner and also the Reddit community created for you. Here, we are proving our methods with real accounts. We trade for several years, and we show that it can be done profitably. You can subscribe as all profits go to our subs. You can find all the details about our accounts. However, since you are new in trading, using real money is almost forbidden. Practice will make you better, and do not expect fancy cars and fake promises. Trading is real challenging, and the numbers are against you. You won't need any money to start, and everything is totally free. For most of our videos, you will find a link in the description that will lead you into a more advanced version of the video, but as beginners, I do not recommend. Stay with the basics and demo trading. So let's begin your journey. You want to learn how to trade, am I right? Well, remember that trading is a marathon and very risky. But risk comes always with a reward. Lesson 1. What is Forex? Forex stands for foreign exchange. It's a global financial market that allows you to trade or exchange currencies. These are binary systems because we have always to deal with two currencies. If you believe one currency will become stronger than the other and you end up correct, then you make profit. Practically, you are already a trader, but you don't know it. Every time you are visiting another country, you need to get local currency for your transactions. You go up to the counter and you notice a screen displaying different exchange rates for different currencies. An exchange rate is the relative price of two currencies from two different countries. Let's give an example. Let's say that you find Japanese yen and you think, whoa, your $1 is worth more than 135 yen. And you have $10. So you think that you're going to have the time of your life there. When you do this, you have essentially participate in the Forex market. You have exchanged one currency for another. In Forex terms, if you sold dollars and bought yen, before you go back home, you stop the currency exchange to take back your US dollars. However, you notice that the rate is different. These changes in the exchange rates allow you to make money in the foreign exchange market. And this is how it is done. Forex or FX stands for foreign exchange market, and it is the largest financial market in the world. It's a global market where all currencies change hands. Exchange rates change by the second, so the market is constantly moving. Only a tiny percentage of currency transactions happen in the real economy, involving international trade and tourism, like we explained before. Most of currency transactions that occur in the global FX market are traded for speculative reasons. We are speculators. Currency traders are speculators, trading currencies hoping that they will be able to sell them at a higher price in the future. We are talking about the biggest market in the world, approximately 7 trillion daily. To give you an example and how big is the market size, New York Stock Exchange is roughly about 20 billion per day. Tokyo stands in the second position with 19 and London with about 7. You understand that currency market is the biggest player. Most of the time when you hear financial news, it will be about New York Stock Exchange. But if you actually compare it with the Forex market, you will understand the different sizes. The currency market is over 200 times bigger. The number is huge. 6.6 trillion number covers the entire global foreign exchange market. But the spot market, which is the part of the currency market that's relevant to most Forex traders, is smaller at 2 trillion per day. And then if you just want to count the daily trading volume from retail traders, that's us. It's even smaller. It is very difficult to determine the exact size of the retail segment of the FX market. The market rarely closes. It's open around the clock. The Forex market is open 24 hours a day, 5 days a week, only closing down during the weekend. So unlike the stock or bond markets, the Forex market does not close at the end of the day. Instead, trading just shifts to different financial centers around the world. The day starts when traders wake up in New Zealand, then move Sydney, Singapore, Hong Kong, Tokyo, Europe, London, and finally New York, before trading starts all over again in New Zealand, a 24-hour cycle. What exactly is traded in Forex? The simple answer is money, and to be more specific, currencies. We are not buying anything physical, and I will give an example. Think of buying a currency as buying a share in a particular country. The price of the currency is usually a reflection of the market's opinion on the current and future health and prosperity of that economy. In Forex trading, when you buy, let's say GBP, you are basically buying a share in the GBP economy. You are betting that the UK economy is doing well and will even get better in the future. You are hoping that when you will sell your GBP back to the market, you will end up with a profit. The exchange rate of a currency versus other currencies is a reflection of the condition of that country's economy compared to other economies, as we described earlier. The better an economy of that country performs, the most likely the currency will become stronger. But how many currencies there are out there? Well, there are 180 currencies in the world among 197 countries so far. We won't give any crypto example as we want to learn the basics. While there are potentially lots of currency you can trade, as a new trader you will probably start trading with the major currencies. And why we call them major? They are major because they represent some of the world's largest economies. There is no absolute definition on what are major currencies. You have to use your common sense. Examples of major currencies are USD, Euro, GPY, GPP, and CHF. Don't worry, you will learn about them in time. Another category is commodity currencies, Australian, New Zealand, and Canadian. To have a common place to stand and to keep things simple, we will just consider all these 8 currencies we mentioned as the majors. These currencies have nicknames and most of the times you will hear them as follows. For the USD is the bag, the Euro is the fiber, the JPY is the yen, the GPP is the cable, the Switzerland is the Swissy, the Canadian is the loonie, the Australian is Aussie, and New Zealand is Kiwi. Currency symbols always have 3 letters, where the first 2 letters identify the name of the country and the third letter identifies the name of that country's currency. These 3 letters are known as ISO 4217 currency codes. By 1973, the ISO organization established the 3-letter codes for currencies that we use today. Take JPY as an example. JP stands for Japan and Y, the third letter, is the yen. The currencies we have included are called the major because they are the most widely traded ones. Every single pair and nickname has a small story for some nerds that are watching this video. In Forex trading, when you are buying one currency, you instant sell the other. Currencies are traded through a broker or CFD provider and they are traded in pairs. They are quoted in relation to another country. For example, the euro and the US dollar. The pair is called Euro USD. For the British pound and the Japanese yen, the pair is called JPP JPY. We have so many countries and pairs that the market can become chaotic, but that's why we are here. As we said, when you trade in the Forex market, you buy or sell pairs. An exchange rate is the relative price of 2 currencies from 2 different countries. Exchange rates fluctuate based on which currency is stronger, as we described earlier. There are 3 categories of currency pairs: the majors, the crosses, and the exotics. The major currency pairs always include the US dollar. Cross currency pairs do not include the US dollar. Crosses that involve any of the major currencies are also known as minors. Exotic currency pairs consist of one major currency and one currency from an emerging market. So let's explain each category. Major currency pairs. The currency pairs that are shown are considered the major. These pairs all contain the US dollar on the side, and there are the most frequently. There are 8 major currencies as we described earlier. There are only 7 major currency pairs. Compared to the other 2 categories, crosses and exotics, price moves more frequently with a major, which provides more trading opportunity. At least in the beginning, this will be a good starting point for you. The majors are the most liquid in the world. Liquidity is used to describe the level of activity in the financial market. In Forex, it's based on the number of active trades buying and selling a specific currency pair, and the volume being traded. The more frequently trading, the higher the liquidity. The second category are the crosses or minors, major cross-currency pairs or minor currency pairs. I know it's becoming a bit confusing, but you will get it in time, trust me. Currency pairs that include any 2 of the major currencies except the US dollar. Not as frequently traded as the major, the crosses are still pretty liquid and still provide plenty of trading opportunities. The third category are exotic currency pairs. An exotic currency is a currency from countries with developing or emerging markets. Exotic currency pairs are made up of one major currency paired with a currency of an emerging economy, such as Mexico, Turkey, Hungary, and so on. Unlike other financial markets like the stock exchange, the Forex market has neither a physical location nor a central exchange. It is considered an over-the-world, an OTC market, due to the fact that the entire market is run electronically within a network of banks continuously over a 24 hours period. This means that the FX market is spread all over the globe with no central location. Trades can be placed anywhere as long as you have an internet connection. It is traded globally by a large number of individuals and organizations. The US dollar is the most traded currency, making up to 85% of all transactions. The euro is second with 40%, while the GPY, the yen, is third with 20%. As you can see, most of major currencies are hogging the top spots of the list. The dollar is king in the Forex market. In fact, according to the International Monetary Fund, the IMF, the US dollar comprises roughly 60% of the world's official foreign exchange reserves. Every investor, business and central bank own it, and they pay attention to the US dollar. There are also other significant reasons why the US plays a central role in the Forex market. The United States is the biggest military power, is the largest in the world, has the largest and most liquid financial markets, stable political system. The US dollar is the reserve currency of the world, represents about half of international loans and bonds, and the US dollar is the medium of exchange for many cross-border transactions. And what I mean by that? For example, oil is priced in US dollars, also called petrodollars. So if a country, for example, wants to buy oil, it can only be bought with US dollar. This means that this country has to buy US dollars first in order to get the oil. The entire world depends on continuous USD supply to facilitate trades, payments, and loans as we described. And this is the reason the US is one of the most important currencies. So far you've learned what is the Forex market, the size of the market, the type of the currencies, and how they are sold in pairs, but how do you trade Forex? Let's take a look. Traders came up with a number of different ways to invest or speculate it in currencies. In Forex, the term investment is not so appropriate, at least in my opinion. And of course, you're always hearing my opinion in all of these series and in all of these episodes. We are speculators, no doubt. Among the financial instruments, most popular one are retail Forex, spot FX, currency futures, currency options, currency exchange traders or ETFs, Forex CFDs, and Forex spread betting. There are too many, I know, but don't get lost. We will analyze and explain with every single detail. Currency futures. Futures are contracts to buy or sell a certain asset at a price on a future date. That's why they are called futures. Currency futures were created by the Chicago Mercantile Exchange in 1972. This will help you in the future, and we will dive into the subjects as part of the sentiment analysis. For the moment, we will move on. For currency option. An option is a financial instrument that gives the buyer the right or the option, but not the obligation, to buy or sell an asset at a specified price on the option's expiration date. If a trader sold an option, then he or she would be obligated to buy or sell the asset at a specified price at the expiration date. Just like future options are also traded, the disadvantages in trading FX option is that market hours are limited for certain options and the liquidity is not nearly as great as the futures or spot market. Currency ETFs. A currency ETF offers exposure to a single currency or basket of currencies. Currency ETFs allows ordinary individuals to gain exposure to the Forex market through a managed fund without placing individual trades. ETFs can be used to speculate on Forex, diversify a portfolio, or hedge against currency risks. ETFs are created and managed by financial institutions, that buy and hold currency in a fund. They offer shares of the fund to the public on an exchange, allowing you to buy and trade these shares just like ordinary stocks. The limitation in trading currency ETFs is that the market is not open 24 hours. Also, the ETFs are subject to trading commissions and other transactions fees. Spot FX. The spot FX market is an off-exchange market, also known as an over-the-counter OTC market. I don't know if you remember the example we gave earlier. The off-exchange market is a large and liquid financial market that operates 24 hours a day. It's not a market in the traditional sense because there is no central trading location or exchange. In OTC market, a customer trades directly with a counterparty. Unlike currency futures, ETFs, and most currency options which are traded through centralized markets, spot FX are over-the-counter contracts, like private agreements between two parties. Most of the trading is conducted through electronic networks or telephone. The primary market, or FX, is the interdealer market, where FX dealers trade with each other. A dealer is a financial intermediary that stands ready to buy or sell currencies at any time with its clients. The interdealer market is also known as interbank market due to the dominance of banks as FX dealers. The interdealer market is only accessible to institutions that trade in large quantities and have a very high net worth, bank, insurances, companies, pension funds, large corporations, and so on. In the spot FX market, an institutional trader is buying and selling an agreement or contract to make or take delivery of a currency. A spot FX transaction is a bilateral agreement to physically exchange one currency against another currency. This agreement is a contract. This means this spot contract is a binding obligation to buy or sell certain amount of foreign currency at a price that is the spot exchange rate or the current exchange rate. Let's give an example. So, if you buy Euro USD on the spot market, you are trading a contract that specifies that you will receive a specific amount of euros in exchange for US dollars at an agreed upon price or exchange rate. It is important to point out that you are not trading in underlying currencies themselves, but a contract involving the underlying currencies. Even though it's called spot, transactions aren't exactly settled on the spot. In reality, while a spot FX trade is done at the current market rate, the actual transaction is not settled until 2 business days after the trade date. Retail Forex. There is a secondary OTC market that provides a way for retailers, for us, traders, to participate in the Forex market. Access is granted by so-called Forex trading providers. Forex trading providers trade in the primary OTC market on your behalf. They find the best available price and then add a markup before displaying the price on their trading platforms. This is similar to how a retail store buys inventory from a wholesale market, adds a markup, and shows a retail price to their customers. Forex trading providers are also known as Forex brokers. Technically, they are not brokers because a broker is supposed to simply act as a middleman between a buyer and a seller, between two parties. But this is not the case because a Forex trading provider acts as your counterparty. This means if you are the buyer, it acts as the seller, and if you are the seller, it acts as the buyer. To keep things simple for now, we will still use the term Forex broker, since that's what most people are familiar with, and we will cover it with more details in the future. Forex spread bet. Spread betting is a derivative product, which means you don't take ownership of the underlying asset, but you speculate on whichever direction you think its price will move up or down. A Forex spread bet enables you to speculate on the future price direction of a currency pair. Spread betting is considered illegal. Despite being regulated by the FCA in the UK, the US considers spread betting to be internet gambling, which is currently forbidden. Forex CFD, a contract for difference. CFD is a financial derivative. Derivative products track the market price of an underlying asset so that traders can speculate on whether the price will rise or fall. The price of a CFD is derived from the underlying asset's price. A CFD actually is a contract between a CFD provider and a trader, where one party agrees to pay the other the difference in the value of a security between the opening and the closing of the trade. In other words, a CFD is basically a bet on a particular asset going up or down in value, with the CFD provider and you agree that whoever wins the bet will pay the offer, the difference between the asset's price when you enter the trade and its price when you exit the trade. A Forex CFD is an agreement, a contract, to exchange the difference in the price of a currency pair from where you open your position versus when you close it. Trading Forex, CFDs give you the opportunity to trade currency pair in both directions. You can take both long and short positions. We will explain what a long and short position means in the future, so don't worry. If the price moves in the chosen direction, you would make a profit, and if it moves against you, you would make a loss. Thank you very much for watching my video. This entire series is dedicated to people that want to learn on how to trade. Like, leave a comment for the YouTube algorithm and subscribe to my channel for more material. Again, thank you very much for watching. Also, you have to check this video several times, put it back and forward again in chapters that you didn't understand. Trading is not easy. The entire world of trading is not easy. However, remember that risk comes always with a reward. So that's it for now. Thank you for watching our videos. I hope you enjoy. You know that we need your subscriptions, likes and comments for the YouTube algorithm. Help us to make more content and trade safe.